We are now going to talk to Stephen of NextEnergy Solar Fund. So thank you very much indeed for doing this. I've got some slides that we asked you to put together. If you can just sort of tell us about the fund, please. And then if you've got any questions to ask Stephen, please do put them into the chat box on YouTube, and I will put them to him after he's finished talking. So over to you.
Fantastic. Thank you, James, and good morning, everyone. Really interesting overview that. Obviously, it's a very interesting time in financial markets at the moment, isn't it? Appreciate the opportunity to provide an overview of NextEnergy Solar Fund amidst all of that, and the opportunity that we see for investors to capture total returns through solar energy and energy storage in particular. So briefly introducing myself, my name's Stephen Rosser. I am the investment director responsible for NextEnergy Solar Fund. My role encompasses everything from designing and implementing the fund's investment strategies, engaging with our investors, to making sure the assets and our investments within the fund are performing as we will want them to. So the next 15 minutes or so, I'll cover a brief overview of the fund, an outline of our portfolio, the market opportunity that we see for investors at the moment, and also future opportunities that we see for the fund and how we're positioning it for growth. So let me introduce the fund itself. So NextEnergy Solar Fund is a leading solar and energy storage investment platform. Ticker code is NESF. The investment objective is to provide shareholders with attractive risk-adjusted returns from a diversified portfolio of utility-scale solar and energy storage infrastructure assets. Through the portfolio, the fund offers investors an attractive dividend yield that's cash covered and significant prospects for future capital growth. It's a FTSE 250 company, and its investors are also playing a vital role in supporting the transition to a clean, affordable and secure energy system. So just take us on to the next slide, James. Just a little look at the dividend track record. NextEnergy Solar Fund has a very strong track record of delivering a reliable and attractive dividend for investors. Since coming to the market in 2014, the fund has paid out over £350 million in dividends. The current target, as you can see, is 8.43 pence per share. That represents a dividend yield of about 13% today, and we expect that to be 1.1 to 1.3 times cash covered for the financial year. If we take a look at the portfolio, we can understand a little bit more about how we generate that value. So the fund has 101 operating assets that are installed capacity around the world, predominantly in the UK. So combined operational capacity is 934 megawatts, and that's enough to power roughly 380,000 UK homes every year. Most of the assets, as you can see, are in the UK. There is a small amount of capacity in Italy, in Spain and also in Portugal. On average, the fund's assets have a residual life of around 25 years. And over time, and as opportunities present, we expect the majority of the lifetime of the assets to be extended beyond that, in line with the evergreen nature of the fund. We've also invested $50 million in a private international solar fund called NextPower 3. So that investment is really important because it brings some of the higher returns from NextPower 3's international strategy into the NextEnergy Solar Fund perimeter. That's also allowed the fund to co-invest directly into assets in Spain and Portugal, alongside some of the largest infrastructure investors in the world. And as you can see, altogether, the gross asset value of the fund is around £1.1 billion. If we move on to the next slide, this is really just looking at the visibility that we have of future cash flows. And the reason we have such strong visibility is because the core of the fund's revenues are derived from RPI-linked government subsidies. Those account for just over half of the fund's revenues and provide a stable and really reliable set of core cash flows that underpin everything we do across the fund. The balance of revenues come from selling the clean electricity we generate to a few different types of buyers. That's mainly utilities, but also some major corporates and power purchase agreements. The power sales themselves are managed by a specialist energy sales desk within NextEnergy Capital as the investment advisor. The team uses its very deep knowledge of energy markets and energy trading to sell forward small clips of power and builds up a hedge position over time, as you can see on the wheel charts to the right-hand side of the slide. This approach allows the fund to lock in attractive prices where there's opportunities to do so, and also reduces exposure to wholesale price volatility in the front years. We're putting all of that together with the subsidy revenues that provides high visibility of future cash flows that support the work we do. If we move on, we can have a look at an illustration of how those cash flows translate into shareholder value by looking at the interim results for the 6 months to September 2024. So over that period, the portfolio generated 595 gigawatt hours of clean electricity and also realised a profit on the sale of some of its investments. Net of portfolio costs, the reported income, therefore, of the fund for the period was £45 million. And after the operating expenses and financing costs at the fund level, there were £37 million of net cash available for distribution. Of that, you can see £25 million was paid out as dividends. The surplus was reduced to reduce some short-term debt, buy back shares, reinvest in the health of some of the existing portfolio, and also some small investments towards future growth. If we move on, I mentioned that we see a current market opportunity for investors, which makes sense to explore. So since coming to the market in 2014, NextEnergy Solar Fund has delivered total returns of around 40%. Every quarter, the fund publishes its net asset valuation, or NAV, using data from independent sources such as ONS, HM Treasury, third-party power market consultants, and a variety of others. Over the last 2 years in particular, we've seen a number of solar and storage assets being bought and sold in the market, including some successful asset sales by the fund itself. In each case, those assets were sold at a premium to the fund's NAV, which provides confidence that the NAV is a fair reflection of the value of the assets in the portfolio, and potentially even with opportunities to the upside, given some of the premia that we have seen and that within the fund itself we managed to achieve. By contrast, as you can see, the shares in the fund currently trade at a discount of around 30% to the NAV, which is in line with peers across the sector, but fundamentally not justified by a reference to the sort of quality and the performance of the assets in the portfolio itself. So if the share price discount isn't driven by what's going on within the fund, which we don't believe it is, the question is, what is driving it? The short answer to that, in our view, is the combined impact of inflation and increases in the Bank of England base rate across the wider economy over the last couple of years. And for investment companies, those macroeconomic factors have led to compounding challenges on mainly 3 fronts. Firstly, typical holders investment companies, such as wealth managers, have had to liquidate quite a lot of their positions to fund redemptions by their underlying investors, who themselves have been trying to navigate the significant increases in mortgage costs and other wider cost of living challenges. Secondly, institutional investors have been steadily withdrawing capital from UK markets and investing elsewhere in the world. So it'd be really interesting, given what's going on with tariffs and other market volatility, to see how that evolves. And finally, over the last couple of years, as everybody will know, UK gilt rates have been increasing, and that's attracted some of the capital that might otherwise have looked to infrastructure investments for long-term, low-risk returns. So just pulling all that together, the macro conditions have driven some types of capital away from small and mid-cap listed investment companies. And you might say that the investment company sector as a whole has rather fallen out of fashion. But although the recent tariff announcements by the US and the international response have increased uncertainty over the last couple of weeks, we are seeing signs in the underlying data that the tide should start to turn. So, for example, February's GDP growth data was more positive than expected, and the forecast immediately before that showed inflation heading back towards the Bank of England's target range. So whilst the tariffs position has been creating a distortion of late, So the underlying outlook supports a phased reduction of base rate and over the medium term a tightening of gilt yields, which will obviously help.
No.
Even before the volatility, international investors were starting to recognise the opportunities in UK equities and starting to direct capital towards undervalued stocks with strong fundamentals, such as NextEnergy Solar Fund. Changes also to cost disclosure rules for investment companies should also help by removing artificial distortions. And the potential changes to pension fund rules as well should also make it easier for them to invest more aggressively in energy transition. And then beyond all of that, the government, as you probably all know, has laid out ambitious plans to achieve a clean power grid by 2030 and to hit net zero by 2050, for which capital will have to flow at really significant scale across equity and debt markets and private markets to deliver anything like the capacity that we need. So altogether, those are really important tailwinds, which we really expect to add momentum to the share price over the months ahead. And if you put all that together, savvy investors might well conclude that the current share price is an attractive entry point and that the current level of discount mightn't be around for much longer. But even though all those drivers of the discount, as we see them, are macro related, we're a proactive investment manager and we remain focused on doing what we can to narrow the discount. So, for example, shortly following the mini budget in 2022, we recognised that discounts might become a bit stubborn and that it would be important to provide visibility of the fund's plans for responding to that evolving environment. So we initiated and announced early a programme to recycle capital from certain investments, through which we've released £72.5 million so far, enabling the fund to reduce short. Which is about this is about outlook and opportunities for future growth. We see, as I will have touched on, an enormous opportunity, for further solar deployment and storage deployment, in pursuit of the 2030 ambitions in the UK. And to put the fund in the best position to benefit from that opportunity, we've built within the fund itself a proprietary pipeline of near-term opportunities to put over £500 million worth of capital to work across a number of new solar and energy storage projects when the time and the environment is right. That pipeline itself is exclusive to the fund, and it's separate to the 10 gigawatt international pipeline of projects which the fund can also access through the relationship we have with the development team at Starlight, which exists in the rest of the NextEnergy group. So the combination of, I was pulling everything together, the combination of the carefully curated portfolio of assets that we currently have, which are performing very resiliently, the supportive policy environment and the underlying economic outlook previous to all of the tariff movements, we think builds a really exciting opportunity for the future of the fund. And of course, the team and I are very highly motivated to start unlocking that potential and driving significant further value for investors over the years ahead. So I was just saying, pulling everything together. So really resilient portfolio, supportive policy environment, underlying and improving economic outlook for the sort of medium term, albeit there's some uncertainty now as a result of the tariff situation. And then the opportunity set that we have within the fund, we think all of that together creates a really exciting opportunity and future for the fund. And of course, the team and I at NextEnergy Capital are very highly motivated to start unlocking all of that, to harness that potential and drive significant further value for investors over the years ahead. So I think that sort of brings the presentation to a close. But obviously very happy to take any questions as long as the technology will play ball. And James, if I hand back to you.
No, thank you very much, Stephen. That's good. So I think there's sort of a big question here, which is kind of alludes to what you've just been talking about in terms of what the fund is for. So you've built a large portfolio of energy producing assets, and that's great. But in terms of trying to drive towards net zero, the important thing is to get this pipeline built. So is recycling the capital the real focus now, or do you have to be careful to keep generating the income? Is that more of a focus?
The focus is actually a combination of the two of those things, and it's about getting the balance right between driving that sort of yield performance, but also harnessing the growth potential and driving capital into new assets over time that deliver that sort of total shareholder return perspective. It probably is an evolution of, the sort of investment companies would have looked at their role and function in life. But I think it's a natural point now for the fund in its life cycle, but also looking at the opportunity that exists around it in the UK in the UK market to be updating its focus to deliver all those things. So it's fundamentally about getting the balance of capital allocation right across all of the different interests.
When you're thinking about making the investment now, I mean, obviously there's debt and some of the underlying structures of these things. Is the level of interest rates changing the way the deals are structured at the moment?
It definitely has an influence. I mean, as you'll have seen across the fund, that our most recent activity has been to sell down some of the investments, which we were amongst the first in the market to be investing in those types of assets anyway, and therefore sort of relatively unique in our ability to realise those investments in fairly short order. So investing pretty quickly post subsidies being reduced or cut for some of them. Obviously we have built and made operational our first energy storage asset in Camilla, which is up in Scotland over the last couple of years. Really important development for the fund. We're not actively in construction at the moment on any further assets, but what remains important for us is the flexibility around that sort of near-term pipeline that I've touched on, which is a combination of domestic and international solar and storage, to make sure that when the time is right, we can deploy capital into those. But right now, the most attractive investment, or investment that is hard to beat, is actually buying back in the shares of the fund. To be really clear, we don't see that as a silver bullet at all in terms of closing the discount to NAV, but it is and it's an important part of the investment landscape, and therefore that's where the focus has been of late, alongside reducing exposure to the sort of the unhedged portion of the debt, which is our short-term debt that exists in RCF. And as I mentioned, that's been downpaid by net 46.3 million over the last 18 months.
In terms of the buybacks, there's a question here about the volume of them. Are you constrained by the liquidity of the underlying shares, or are you constrained by the amount of capital available to do buybacks at the moment?
Again, that's a question about getting the balance right, really. So one of the things that we have thought very carefully about is the timing, sizing and shaping of buyback, and definitely believe that little and often and being a constant presence in the market is the right way forward. There is, as I say, limited. It's very, very hard to disaggregate the impact of a buyback program from other factors that affect share price. But we think it's important to be, just sort of have a constant underlying regular presence in the market rather than doing anything big bang. But we do obviously have to navigate the investment policy limits around gearing and other things as part of getting that balance right.
Yeah, if that makes sense. You've got this exposure to projects around the world. How do you actually manage the operations in different parts of the world and sort of keep a handle on what's going on in these different places?
Yeah, it's a great question. So actually the team, so the investment is in a private equity fund called Next Power 3, which itself is actually managed by NextEnergy Capital, a different team and segregated from the team that I run looking after NextEnergy Solar Fund. But the thing that should provide investors with a lot of confidence is it's the same quality and caliber of people, the same relentless focus on driving value for investors that is applied across all of everything we do, including in that international fund. So in terms of the NextEnergy Solar Fund's team, we don't directly manage that. But of course, we do oversee the reporting, the data. We ask the challenging questions about what's going on in that fund as it is deploying. But it is obviously making great strides in achieving its own ambitions in terms of capacity build out around the world against its I think 1.7 gigawatt operational target. And those guys are doing really well. They're bringing all of that to fruition. At some point over the next handful of years, that fund will come to an exit point and a liquidity event for that vehicle, which in turn, should bring those returns into the fund and give us opportunities, therefore, to do something interesting for investors at that point in time, whether that be a liquidity event for NESF or investment into other opportunities remains to be seen. But all of that further down the line.
Great, thank you. There's a question about the visibility. Actually, there's a couple of questions we can talk to it on the slide, but think about the visibility first. So, generally, where do you see power prices going? I mean, I know you use external forecasters to help you do that, but what do your take on it? Where do you think we're going? And also, to what extent are you seeing more and more corporates using power purchase agreements to lock in power prices in the future?
Yeah, both great questions. Let me take the second one first, and then I'll come back to the long-term outlook for power prices. So in terms of corporate use of corporate PPAs, I think that's still an emerging, evolving space. We definitely see conceptual appetite amongst corporates for that, and a range of types of interest, from wanting to own the generation themselves to wanting to have a medium to long term contracted arrangements with generators. They're quite hard to put together. It's quite a complicated risk allocation, and therefore they do tend to take quite a long time to bring to fruition. And I think that in itself is probably slowing down or constraining deployment and the number of PPAs you see being signed in terms of volumes at the moment. But over time, I would expect that to pick up, both as we come to a more market norm in terms of risk allocation, and there's a lot of education that is needed amongst the community in terms of coming to an alignment about how risk allocation can work, and that will achieve clarity and simplicity and sort of speed up execution, all of which will help. So I do see it evolving and positive movements in that space, but it's still relatively emergent, I would say. In terms of power prices themselves, obviously we use a blend of the main advisors, and we use to fold that into the NAV. What we see is power pricing sort of settling out at a higher level than it was previously, and it's sort of relatively flat trajectory, which is quite a difference from how some people might have been assuming the sort of hockey stick curve in years gone by. We in the NAV don't fold in any house views into power pricing, but I think we do obviously have perspectives, and I think we see opportunities to the upside over the next 5 or 10 years, and that it pays to be a generator on the system right now, because whilst there is an enormous opportunity for the fund in terms of the Clean Power 2030 build out and what have you, the challenges that exist in deploying new assets on the grid generally, and therefore the assumptions that might be being made about how much of that capacity is going to be built, I think will ultimately deliver a slower deployment trajectory for UK overall, or the GB market overall. All of which means, as I say, it pays to be a generator on the system while that's what's happening. So we see opportunities to the upside relative to the curves, but again, we don't fold those into the.
Great, thank you very much. There's a question specifically about tariffs. I mean, do they have any sort of direct practical impact on what you're doing, other than the sort of bigger, wider impact on global economy and sort of.
Yeah, directly, no, or very limited. It's almost too early to comment, if you like, because that situation is obviously still evolving. Where we've got tariffs and then we haven't got tariffs and what have you. So that the sort of 90-day pause in itself is interesting. Although you'll all have seen China's news this morning about increasing up its rate against its tariff rate for US exports to 125% to match. So the real impact for NESF is about the macro there. But in terms of actually our day-to-day operations and asset performance and any of that stuff, very, very limited exposure to that, I would suggest at this point in time. But obviously, time will tell as to whether that will have knock-on impacts down the supply chain. We don't see that right now, but obviously remain alive and alert to it. And if we are able to take protective actions, then we do.
There's a couple of questions, and I think it is probably key given the size of the yield about the sustainability of the dividend. And I think you've talked to the visibility on income and things, but can you sort of just reiterate how comfortable you are with how sustainable the dividend is, please?
Yeah, so as I say, that sort of visibility of future cash flows is really underpinned by the core component of the subsidies, and then the work we do to hedge out the power at attractive prices. Ultimately, what the dividend looks like going forward is a question for the independent board of directors. We work obviously very, very closely with them. And again, it's about getting the balance right between, making sure that we're delivering the yield performance that one group of investors want and delivering total return that other groups of investors are looking for. And also, yeah, well, I suppose it is ultimately about getting that balance, yeah, I suppose there isn't much more to say beyond the
I don't want to
provide
sort of
visibility
trap you into
that
a
we can.
forecast.
Yeah,
Exactly.
yeah, it's very, very difficult. But we expect this year's dividend to be 1.1 to 1.3 times covered, as I touched on. That's very healthy cover. I suppose there is a point about, in terms of that yield, it is not being recognised in the share price, and that therefore there is no reward for maintaining that high level of yield at the moment. But all of that needs to be sort of factored into the round in the board's deliberations, which obviously they work very, very diligently through, and will be doing so over the months ahead.
Thank you for this, and thanks for your time today, and thanks for asking the questions.
Pleasure, no problem. Speak to you soon.
Next week is Good Friday, but before we get there, one thing that I'd like you all to have a look at, please. There's a link on our website to the AIC's My Share, My Vote campaign petition. I don't know how effective this is going to be in terms of a strategy in trying to get the Parliament to change the law, but nevertheless, please do go and you go through the link and sign it if you can. Probably more effectively, if you just make a noise, write to your MP or something, that would probably help. The point, if you go back and listen to the interview that we did with Richard Stone, he explains it all there, but in a summary, we just want the platforms to be forced to allow investors to vote simply and easily, so that we get much greater participation in terms of votes at AGMs and things, as well as in the bigger issues like the sort of cyber stuff. So there's that. As I say, we'll be on holiday next week as Good Friday, but the week after that is the next of our panels, and we'll be talking to three interesting investment managers in the property sector, talking about when REITs might rebound. So have a good break, have a good Easter, and we'll see you then. Thank you very much for your time this morning.